Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SPFC, which is Standard Bank Financial Consultancy. My name is Ketwe Kunene. I'm the coordinator today. Our two presenters is Mr. Errol Meyer and Wynford Heynes. But before I hand over to them, I want to make sure that everybody's comfortable with how the webinar runs. First of all, please make sure the volume of your computer or your laptop is as high as possible so you can hear us clearly. And I'd also like an indication from all the attendees to see if you can hear me. There's a small high five on the panel on your screen on the right-hand side. Looks like a small hand. If you can just click that for me, it'll indicate that you can hear me and that we can continue. Thank you, Ellen. Thank you, Elvin. Thank you, Andre, Andrew, and Ben. Okay, majority of hands coming up. Krista, Claire, thank you so much. I assume everybody's sound is on par. Second situation is the questions. If you have any questions, which I'm sure there will be, please do not hesitate. You may type in your question. There's a questions bar on that same panel on the right-hand side. You can type in your question. At the end of the session, we will then address the questions to the presenters. We'll give you the answers. We do not want to disturb them through their presentation, so it will come at the end, the questions and answers. Okay, let me tell you a bit more about your presenters today. We've got Mr. Errol Meyer, which you most likely know. He's a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estate and Financial Plans, which is now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He previously worked as a legal advisor for corporates and as a tax advocate for SARS. Mr. Errol Meyer is currently our advisory propositions legal specialist at Standard Bank, which is why we always love to have him in the room. His co-pilot and his partner in the crime of education today is Mr. Wynford Heynes, who holds a BSc, BSc Honours, and MSc. He is the head of our retail investment funds here at Standard Bank Wealth. He has accumulated 21 years of industry experience. He joined Standard Bank Wealth in August 2015 to head up the Standard Bank's Retail Investment Funds Initiative, which is the first set of funds that the bank has brought to the market, which is a set of goals-based funds that is housed on the license of Stanlip's management company. Prior to joining the bank, Wynford spent more than 17 years in the investment management industry, of which about 9 years was with multi-managers such as Investment Solutions, South Africa's largest multi-manager, Momentum Outcome-Based Solutions, the insurer's multi-manager offering, being the second largest multi-manager in South Africa, and most recently a short stint at Sydney Asset Management. He is now here at Standard Bank, like I said, as the head of retail investment funds. So today we are talking sustaining your income in retirement. We already got a few questions prior to the session, so I'm sure there's a big interest in it. Ladies and gentlemen, please sit back, relax for the next 40 to 45 minutes as Mr. Heynes and Mr. Meyer take you through this presentation. Errol, thank you very much for joining us. I hand over to you.
Thank you, Kitiwe. Well, good day, all attendees. Let's kick off with financial and investment planning for retirees. Let's talk about accumulation and decumulation. Now, welcome to our webinar today, focusing on post-retirement and investment planning, albeit from a retired employee or a self-employed person. In this webinar, we will be discussing risk concepts such as financial planning risk, as well as investment risk. In particular, Wynford will discuss the choice of asset classes, importance of growth assets, and so forth. The days leading up to retirement is known as the accumulation phase, and the date after retirement is known as the de-accumulation phase. It is with the latter that we are concerned with in this webinar. But let's talk about the concept of retirement. Isn't that perhaps outdated? So let us start the inquiry from a financial planning perspective. Retirement from an employer these days are taking on a whole new meaning. Retirement is definitely not retiring from life and all its challenges, but only from your employer. After all, a retirement day is only a day in your life. And for most people, when the employment contract comes to an end. Now, business people, and especially in the case of family businesses, set their own dates when they want to slow down or to give effect to their succession planning strategy and hand over to a family member. It is mainly these two scenarios that presents itself in the South African environment. Life risks change as a person moves through certain life stages, and many of these stages are quite predictable. This is especially true when one reaches the magic age of 65. But one may ask, is there evolving another understanding of retirement worldwide and also in South Africa? Interesting that the financial planning industry in the United States are talking about longevity planning instead of retirement planning. This opens up a whole new discussion and methodology of financial planning for people who are supposed to be retirees. Now let's talk about the relevance of longevity risk and inflation in a financial plan. The risk of longevity is one of our greatest risks in the modern age we are facing, which is true from a financial as well as an investment planning perspective. Now, in the days of ancient Greece, the lifespan of a person was 20 years. 2,000 years later, around 1620, the life expectancy increased to 35 years. In the United States, around the 1900s, life expectancy increased to 47 years, and now in the 20th century, it is 78.8 years. It was said that children born today will live until 100. It is possible that there may even be a 40-year-old listening to our webinar today that may enjoy his birthday cake with 150 burning candles one day. This is often referred to as the greatest gift of the 20th century, or should I perhaps say greatest risk, given our outdated thinking of retirement. It is not hard to predict that life expectancy will increase exponentially, similar to the rapid advancement in the medical field and improved lifestyles. Modern science and literature is rife with examples of people that are striving to live a better quality of life, and with that comes the obvious benefit of living longer. This raises the simple question, how much capital do I need to retire? And as we are so often reminded, less than 10% of people can afford to retire. Developments in the field of retirement funds did not make things easier. About 20 years ago, most funds converted from a defined benefit scheme to a defined contribution scheme, which squarely placed the risk of investment growth on the individual as opposed to the employer. Now, even today, we still have traditional life annuities as well as living annuities. Most people opt for the living annuity option, where a person can select a drawdown of between 2.5% and 17.5% of the capital. In such case, the investment risk rests now squarely upon the shoulders of the individual and not the fund itself. On the other hand, in the case of the traditional life annuity linked to inflation, the risk is transferred to the insurer to ensure that pensions are paid for life. Which one should one choose? Or perhaps a combination is a question that comes to mind. Now, this fashion of favoring modern living annuities and making one's own investment choices aggravated the problem of outliving one's capital, since many people fail to do proper post-retirement financial planning. Often this is because the individual miscalculated the devastating effect of inflation, selected a too high percentage drawdown of capital, and most importantly, not starting off with a proper financial budget. Let me explain myself. Since a person would like his income drawdowns from a retirement fund to keep pace with inflation, he will increase the yearly drawdown with, say, a 6% assumed inflation rate. Stated differently, if the income drawdown is 100,000 a year one, The drawdown in year 2 will be 106,000, and in year 3, 112,360. Assuming that the funds are invested to outperform inflation by 4%, that's a 10% return, the percentage drawdown rate will increase every year. Since a person selects an amount that keeps track with inflation, it is expressed as a percentage of capital. This will continue until at some stage the inflation-adjusted income will reach a point of 17.5% drawdown. Now, this unforeseen consequence is that at a certain point in time, the retiree is no longer allowed to draw down more than 17.5%, with the result that he will have to reduce his standard of living, since the income drawdown will not keep pace with inflation. Living annuities are thus not without longevity risk, especially when deciding about the inflation-beating investment strategy that one selects. So what to do then? Firstly, from a planning perspective, one should aim to retire later from employment and work for as long as possible. Exactly what the situation was prior to introducing the concept of retirement in the 1880s. Secondly, understand the devastating effect of inflation over the long term. Do a proper cash flow analysis and a financial plan. Thirdly, your choice of investment strategy should match your expected deaccumulation phase during retirement. Fourthly, get yourself a competent financial planner. So what role can a financial planner play? The financial planner that has a solid understanding of the principles that we will discuss in this webinar is crucial, since retirees will need guidance, education, and proper financial planning and investment advice. The challenge relates to the uniqueness of every person's circumstances, his or her own future lifestyle choices, family dynamics, various tax choices at the date of retirement, and very importantly, an inflation-beating strategy for capital to last for his or her life. Now that sounds daunting, unnerving, and intimidating to many, and hopefully we at Standard Bank can give you some insights of how to go about to make wise choices. And conclusion, given that a client must make some choices at the date of retirement, proper advice and planning will be crucial, since once a person has made a choice, it becomes final, and one arrives at a point of no return. And very often corrective measures are not possible. In the modern computerized environment, clients are looking for solid financial planning advice and not only technology. It is especially in the space of post-retirement, or stated differently, the deaccumulation phase. One is faced with the biggest, yet not fully understood risk. And no doubt the advice-driven financial planner will play a crucial role for years to come. In my view, the financial advisor who understands these concepts and the lifestyle risk associated with the deaccumulation will become the sought-after professional. And now I hand you to Wynford, that will explain to us how to go about to deal with these risks from an investment perspective. Thank you, Wynford.
Thank you, Errol, and good day to everyone. Errol has really set the scene nicely there, talking about the longevity risk and the advances that has been made in technology that extends our lifespan. So I think from our side, to better understand how we combine asset classes to construct appropriate investment solutions in this deaccumulation phase, let us proceed and remind ourselves of the specific characteristics of each asset class. So in this case, we'll include a little bit of the risk, the return, and the correlation aspects of each asset class as well. Starting off with local or South African cash, we know that because of its low volatility, cash is considered a safe method of investing in times of market uncertainty. So cash is a low-risk asset class, and this is reflected in the relatively low returns over the longer term that one expects from cash, and these returns will generally struggle to keep up with and outpace inflation. Cash also, as an asset class, tends to have a lower correlation with all other asset classes. If we look at bonds in the South African context, as a result of changing bond prices, they are often driven by the changes in credit ratings of the bond issuer. In other words, the ability that that issuer has to repay its debt and how that is rated. Bonds, therefore, generally represent a more risky or volatile asset class, specifically when compared to cash. And over the medium to longer term, this additional risk would mean that bond investors can enjoy a better return when compared to cash. South African property on the list is an asset class that is close to many of our hearts, and unfortunately the risk increases steadily when you compare that to cash and bonds. But property as an asset class can also provide you with certain tax advantages. However, we know that certain changes in our economy does make it difficult to predict property values over time, and over the longer term investment horizon, this is an asset class that certainly lends itself well to investing in. And finally, with local South African equities, which is very often the point where many people start, stock markets in globally, in fact, can be very volatile, with significant variation being experienced on a day-to-day basis. However, to compensate investors for taking on this relatively high risk of investing in equity, this asset class generally is the one that delivers the higher long-term expected returns. I've made a specific mention of offshore asset classes on this slide because we must never forget about them. I mean, to quote from the latest JSE's annual integrated report, at December last year, that is 2017, the JSE was only the 17th largest stock exchange in the world as measured by market capitalization. So that information alone tells us that there are many more listed stocks and equities, in other words, in world markets that we should definitely be utilizing to diversify our investment solution. If we were to now look at the risk and return characteristics of asset classes, maybe in a different way, and the picture here is fondly referred to as our Smarty Box table. This table shows us how the asset classes, and here we've included the offshore asset classes, and we've also now added the important measure of South African inflation, how they've performed relative to each other over the past 13 calendar years. The one on the left denotes the best performing asset class in that specific calendar year, and the 7 at the bottom the worst. If we were to focus on the asset classes in this table individually, we will see their relative return by looking at the rating of the performance of each asset class. And we will see the risk on how this rating changes, in other words, the volatility, over the 13-year period. So for instance, if we had to focus on South African bonds, we can clearly see how the performance has changed from one year to the next. If we, for example, had to then switch our attention and focus on South African equity, we can see even more variability in the returns from one year to another. And if you look closely at the W symbols that appear, you can see how much longer the letters in the W actually become when we start looking at equity. Importantly, when we start building an investment solution or a portfolio, the largest contributor that explains this performance is the strategic asset allocation. In other words, the mix of assets that we've used in this portfolio. In fact, research shows us that as much as 91% of this portfolio's returns can be explained by its asset allocation. In other words, the mix of asset classes. And only 5% is typically attributed to which securities or stocks were held in the portfolio. But how do we know what asset classes to include in our portfolio, and importantly, how much of each asset class we should be including? And how does this mix of assets change if my goal is to target inflation plus 2%? Or what about inflation plus 6%? So in our case, we certainly rely on investment professionals to build our portfolios to ensure that we are able to meet our investment goals. The first step would typically be for these experts to determine the long term, and in this case, say the 10-year period, the real expected return of each asset class. Of course, when I mean real, I mean the return that is achieved after taking inflation into account. This is often calculated not only based on historical returns, but also on expected future returns for those asset classes. If, for example, we were to single out South African bonds, which is very often the starting point, then we would see that bonds, in our example, could deliver a real return of 3.3% per year. And if we were to assume inflation would average 6% a year, then we would look at a nominal total return for bonds of 9.3% a year. This is just an example. I could extend that to South African equities, where a real return often of 7.3% in our example would be assumed. When added to inflation, that equates to a 13.3% nominal return based on those inflation expectations. It is always important, however, to note that these future expected returns are not produced in a straight line. And that is important because there is inherent volatility that exists in each asset class. So now going back to what I've previously just stated, and to sum up, these real returns, together with the volatility of each asset class and their correlations, in other words, more importantly, how they co-vary with each other, this information is used as input into an optimization process. And this optimization process provides an indication of the best mix of assets to achieve a particular targeted real return or goal. But I always believe that it's much easier to illustrate things with a picture. And of course, we are in the middle of the Soccer World Cup. So the picture that is now on your screen is, I often feel, is much easier to remember. And if we were to look at the portfolio as a soccer team with a goal to beat inflation by 2% a year. In terms, the mix of players in our illustration here will allow us to achieve this goal. And in terms of our team, if we play from left to right, the asset classes will be our soccer players, whose purpose it is to win the match by scoring goals against the other team. And in this case, the other team is inflation. We can therefore think of cash as our goalkeeper. A goalkeeper prevents losses, but doesn't necessarily score goals. In other words, doesn't necessarily earn high returns. Next in our team would be the bonds. Over the long term, bonds generally enjoy superior returns to cash, as I've stated before. And we can think of bonds as a defender or a midfielder. Equity, as you can see in the right-hand half of our picture, would be part of our team because they would be there to compensate investors to take on the relatively high risk of equity investing. So in the long term, equities would produce the returns that we require, and they would represent our attackers in the soccer player analogy. They don't stop the other team necessarily from scoring. That is, they don't prevent losses. That's important. But they score goals. That is, they do earn the higher returns. And of course, our team lineup can change if we were to beat or set ourselves a higher goal. In this case, a goal of beating inflation plus 6%. By changing the mix of players and by adding more attackers, equity, and taking away some of our midfielders, bonds, you will have generally a more volatile portfolio. However, you will score more goals. So this big mix of players with less midfielders and more attackers allows us to achieve our goal. What we've just seen is that in order to achieve higher inflation-beating returns, that is our goal of beating inflation plus 6%, a portfolio needs to have a larger exposure to more aggressive or volatile asset classes such as equity, since these are the asset classes that deliver higher long-term returns to compensate investors for taking on the relatively high risk that the asset class represents. However, we are all human, and the terms more aggressive, more volatile, higher risk often conjure up the wrong emotional behavior with investors, and particularly so when it comes to investing their hard-earned retirement savings. So for this reason, we'll instead refer to these types of asset classes as growth assets and distinguish them from asset classes that carry less investment risk, which we will refer to as defensive assets. So as you can see on your screen, property and equity are what we would classify as growth assets, while cash and bonds are what we would classify as defensive assets. And what I've indicated on the screen as well would be typically examples of what we currently believe the long-term expected real returns for each asset class would be. If I were to break down this asset allocation and utilize Standard Bank's gold standard range of funds into breaking this down into growth assets and defensive assets, then this is the picture that would emerge. On the left-hand side, you can clearly see a portfolio such as our Gold Defender Fund of Fund is constructed with an asset allocation framework that would allow the portfolio to beat inflation by 2% a year. And this portfolio has as much as 85% of its assets classified as defensive assets. Whereas on the other hand, a portfolio such as Gold Accelerator, which is constructed with an asset allocation framework to allow the portfolio to beat inflation by 6% a year, only has 5% of the portfolio invested in defensive assets and as much as 95% invested in growth assets. Of course, it's important to note that these asset allocation weights vary on a tactical basis, but the long-term strategic weights remain pivotal to allow the portfolios to perform in line with what is expected of them. Of course, looking at the different portfolio options, it is also clear that the uncertainty of achieving returns using a more aggressive solution, that is a solution with more growth assets, might dissuade investors from selecting aggressive portfolios. However, we have yet to look at the effects of time or a holding period. And the longer the holding period, the lower the risk of an asset class, such as equity, which is what we're showing you on this picture, and hence the aggressive portfolio. This is because sporadic bouts of losses in the stock market are effectively averaged away over longer periods of time. So you will see in this graph that over any 1 year period, equities can be very volatile, and the returns can vary from as low as minus 38% to as high as 72% positive. However, you can also see that over the longer term, as we extend the holding period, the range of returns not only narrow, but after holding equities for more than 5 years, one generally only experiences positive returns. And that is something for us to remember. So of course, having dealt with the growth and defensive assets in the asset allocation framework, let's just quickly recap and look at the alternative vehicles available in retirement. As Errol previously referred to, generally investors choose between a life annuity and a living annuity. And as Errol also pointed out, the living annuity is often the preferred choice. Just some salient features of each, and these are very high level. On the life annuity, it provides you with a guaranteed income for life, which means it removes investment and longevity risk. It also continues to provide an income to a retiree spouse. However, you cannot freely choose your income amount, in other words, the drawdown of your capital, unless you've linked it to an inflation-linked annuity. And the remaining funds at the point of death cannot be distributed to heirs. Living annuities, on the other hand, one can choose to receive between 2.5 and 17.5% of the capital invested each year, that is the drawdown, and the remaining funds at the point of death can be distributed to your heirs. However, the retiree takes the investment and the longevity risk. Let's delve more deeply into the relationship between drawdown rates, real returns, and sustaining an income in retirement, because when it comes to a living annuity, if the drawdown rates are too high, or the retiree lives longer than expected, or the real return targeted is not aggressive enough, the retiree may run out of money. So what you will see on this following slide is that given a certain starting annual income, which we've expressed as a percentage of the capital invested, that is the drawdown percentage, the table details to us what real return, that is what inflation beating return would be required in order for an investor's money to last them 10, 20, 30 or 40 years. The table sets out the results of this modeling using the following assumptions. The initial drawdown is adjusted by inflation each year, and in this instance we've assumed 6%. And there's no change in returns for the investor. In other words, they receive a constant return every year. So for example, if an investor was to withdraw 4% of their capital invested from year one onwards, and this increases with the 6% inflation adjustment every year, then the table highlights to us that a real return of about 2.4% is required for this capital to last 30 years. Another example, if for example 8% of the total capital is withdrawn from year one onwards, and this increases with the 6% inflation adjustment every year, then a real return of about 8.7% is required for this capital to last 30 years. It is therefore very clear to see the impact a higher initial drawdown percentage has on the real return required of the portfolio in order for the retirement income to be sustained over the same period. Higher real returns also mean a higher exposure to growth assets, as previously illustrated, and herein lies the crux of the matter. Because the question therefore remains as to whether investors make adequate asset allocation adjustments when they change or increase their drawdown rates. Perhaps we can illustrate this slightly differently. The graphic that appears on your screen illustrates a 4% annual income draw that again increases with a 6% inflation adjustment every year. And it's based on an initial total capital invested of 1 million rand. The gray line shows how the capital changes over time, peaking at about 1.724 million rand after 21 years, and then decreasing in a steady pattern thereafter. The blue, amber, and red bars show the annual annuity income that is earned, with the income in year 30, that is the amber bar, no longer able to increase with inflation because the 17.5% maximum drawdown limitation comes into play. The income drawn from year 31 onwards, that is the red bars, now start decreasing in real terms. And this is the warning sign that an inflation-adjusted standard of living is no longer achievable unless a plan is made. If we were to overlay the return objectives targeted by Standard Bank's gold standard funds of funds, we can see which funds would be appropriate, broadly speaking, to achieve the desired real return required. For example, if a retiree requires an annual drawdown percentage of 4% and wants this income to last them for 30 years, then they will need to be invested in the Gold Conserver Fund of Fund. The real return that's required is 2.4% per annum, and Gold Conserver is built to produce a return of CPI plus 3% over rolling 4-year periods. If the retiree increases this drawdown percentage to 5% a year and also want their income to last for 30 years, then they need exposure to more growth assets. And the more appropriate fund would be Gold Advancer in this example, which has been built to deliver a targeted return of CPI plus 5% over running 6 years, given that the required real return in this example is over 4% per year. These are just examples to illustrate how the bank's gold standard range of funds fit into this framework. In conclusion, because I'm sure there are many questions that we are going to be fielding, people on average live longer today than ever before in human history. Errol has given us a really good detail on that. As a result of living longer, the life expectancy we need to provide for an income during this period has a far longer time frame. The need to match these investment time frames with an appropriate inflation-beating investment solution is absolutely vital. The how, of course, lies in finding the correct asset allocation that includes appropriate exposure to growth assets. I'm going to hand over to Ketiwe because I'm sure that there would be many questions that would follow.
Thank you so much, Wynford. That was very informative. Let's see if any questions have come up. I'm going to start with the first question that came up during the session. Got a gentleman who said he retired in 2017. So he's invested his pension with a well-known insurance company for a year now. He'll be 63 in July, and he's seen no growth in his funds. And he wants to know, what should he do? Does he perhaps continue on this path or change to maybe a money market? And his drawdown is 4%. So you can answer that one in the meantime.
Well, Wynford, my thinking would be, first of all, one should start off with a plan. And with a plan, you should start with a budget. I don't think one should look at or start off with a percentage drawdown. Do it the other way around. Start with how much income do I need, then do the cash flow analysis, because you've got to increase that with inflation. And we spoke about 6% inflation. I mean, after retirement, we can easily talk about 10% inflation. We look at medical expenditure. So that is why it's so crucial that you actually must beat or have a strategy that beats inflation. Now, I think we've answered a lot of those, the question, we've answered a lot of those aspects already. But Wynford, from put it down, money market to be safe, I mean, I would tend to think that's the worst decision that you can actually make.
Yeah, Errol, I would agree, because I think at the end of the day, what we were trying to highlight in the webinar was the need to actually have sufficient exposure to growth assets. And we've defined money market similar to cash as a defensive asset class. So the question does the person does not give us details on the time frame, but certainly we can assume that it would be an extended time period because of longevity that we've spoken about. And yeah, I mean, without knowing all the details, my sense also is that it would probably be ill-advised to move at this stage from where they were invested into a money market solution.
Okay. Thank you, gents. We've got Ms. Kokanani Mkwanazi, who sent us a question. She says, how do I balance accumulation with deaccumulation? If a person can live up to 150 years, this means accumulation phase of approximately 45 years has to last for 85 years. Do we have investments for 85 years?
Yeah, I think it always starts with a plan once again. I think in my introduction, I challenged the concept of retirement. And if it's true that very soon people are going to live until the age of 100, I think we should get rid of the word retirement in the dictionary, as a matter of fact. Some people often refer to it as rewire or put on some new tires. So become more productive. So go back to prior to 1880, where people worked until they couldn't anymore. Now with the advanced technology and the medical, I've even heard that the unemployment rate is the best for people who have retired because of the skills and the working capabilities, and also for them to transfer their skills to which is so much needed often. I think they can play a very useful role. So I think start off by saying, Why should I retire if Charlie Munger and Warren Buffett at 90 can entertain the world on investments? I mean, try go for 80 or 85. That would reduce the problem of deaccumulation then at the end of the day.
Yeah, Errol, if I can add to that, yeah, that's quite a startling thought if one thinks about accumulating for 45 years and then deaccumulating for 85 years. I mean, that's something that we don't think about. But a one-line simple answer to that is, if I wanted to just sit back, kick my heels back and enjoy 85 years of bliss, then for me, I would pass that risk on to a life company and make sure that they can carry that risk and make sure that I at least receive income that keeps up with inflation. So an inflation-linked annuity would be a very good example to be using as a solution for that. But of course, as Errol said, the concept of retirement is something that we're going to retread, and we're going to be doing different things. So I wouldn't say that we have specifically. There are many investments that would cater for that time period. But remember, as I've illustrated on the slides, is 85 years would be a very long time. Investing in equities over such an extended time period would certainly be another alternative that one could consider. But does one have the stomach to deal with down periods, as many of our readers or listeners are currently faced with, and to stick to that strategy on your own? Or do you need a financial coach to keep you on that road?
Yeah, maybe we can let me just add on to that one. That the goals-based financial planning is so important, and people tend to think that you only have goals until the date of retirement, and that is absolute nonsense. I mean, at the date of retirement, some people used to call it bucket list, but you should have goals in the retirement. So I would say, if your employer says that at 65, that's it, I'm going to pull the plug on you, perhaps in your accumulation phase, what you should have done is invested some monies for a hobby to turn it into a venture, like photography or running a diving school. So there you can make use of investments like your tax-free investments and build up that fund. So the day that you retire, you can actually postpone your retirement benefits until a later day and live off this cash amount. So that is where the accumulation phase comes in. And think about goals in retirement. Your only goal is not to retire. Is when I retire, which is only one day, what do I still want to do? 10 years after retirement, I want to do this. And then later years, maybe a little bit of traveling, and then a real slow stage in your life, then maybe you need your capital to substitute and work for you.
Makes sense. And that falls onto God's question. I think he's asking from a planner perspective here. The answer is similar, I'm sure, that you'll give. Should we keep working on the 79-year-old average lifespan when doing retirement planning, or should we adjust it then to say 85 or 90 years of age, or should we be a little more aggressive, possibly investment selections to make up for the possible longevity of the client? And then on the F&A question, the financial needs analysis, should it be adjusted then for us to do these type of calculations for our clients, as F&A only works on the average calculation of lifespan?
Yeah, you know what? I think the time is long overdue. We should start adjusting. As I said earlier, I mean, you look at the life expectancy, 20, it jumped to 30-something, and then to 40-something, and all of a sudden, it is now. I think already it's way longer. But so God, to answer you that, you know what we have to do is, as financial planners, we look at the risk profile of the client. And risk profiling is the character, that unique circumstances of that particular client. And that client, it depends whether he's married. You can look at the history of his parents, how long they lived, look at their lifestyle, look at their health. All of this will give you some indication as to perhaps make sure that you have sufficient funds. And then consider the question, so many people want to leave something for their children, a legacy. Let me tell you something. The legacy is often the education that you've given them, the opportunity to work. But to have a retirement fund and still hope for a legacy, maybe we should think twice about that. And rather have teach our children that to look after themselves, because already, if you're at my age here and the 50 plus, it's a sandwich generation. We've been squashed from the children as well as that from the elder parents. Let's teach our kids to do better.
Nice, Errol. And then Andre Bazerenhout asked, I retired early at age 59 and opted for a preservation fund with moderate risk. The aim to convert to a living annuity not before age 63. What are your views?
Errol, can I answer you?
Yeah, I look at it. We need more information. It's also all about risk profiling, but I think you already gathered that. My first question is why 63? Does it have to be 63? And if it's 63, and for whatever the reason may be, then make sure that the investment strategy that you choose will be able to ride for as long as you live. So I think one needs a little bit more information, but I always urge people that if you can postpone that retirement date, it would be so much better. And an interesting fact is that other countries in the world already are proposing the retirement date to be pushed to a later date. Interesting, in South Africa, the legislation is that where you retire from your employer, previously you had to retire from your pension fund. The rules have changed that you can actually retire from your employer and then from your contract, but you can leave your funds there to retire from the fund at the later stage. So we find that legislation is moving in this direction of longevity. So I think what you have to do is look at your risk profiling, and if it possible is to postpone. If not, then do some serious cash flow planning and make sure that your investment strategy, as Wynford has spoken about, is then 100% aligned.
Nice. Errol, another interesting one from Pigele Linkosi. He says, I still have some time to go before retirement. I need a good financial planner. How do I go about identifying one?
Well, I think what one should do is, if you would, let's just state it differently. If you want a good doctor, what would you do? You'll go on the references. You'll go to somewhere where it is a reputable company that has been around for some time, and then look if that person is adequately qualified, and what's the due diligence that such an institution will follow to make sure that they have the client's heart at interest. Now, at Standard Bank, we have many people that are certified financial planners, which is a very high qualification, and we are an institution that can provide all of those services. So anything similar like that, but CFP, an institution that's accredited, I think that would be your criteria. And then it depends on personal experience, because you have to build a relationship with that particular individual. So preferably, you may be at a very good stage that while you are building up towards a retirement, because remember I said, at the date of retirement, you've got one chance. It's a point of no return. You mess that up, you mess that up for life. So start building that relationship now with a reputable advisor that adheres to these qualifications that I've just spoken about.
Okay. Wynford, this might be for you. It's from Desmond Hudson. He says the market has basically tread water this year, except the past few weeks. How do I ensure continued growth while having chosen a percentage drawdown and needing that income to live?
Yeah, I can see where that's not an easy one, because obviously you said it was Desmond, is living off that income on a day-to-day basis. Of course, this takes us back, and I'm going to hand over to Errol to complete this, because I think there's a financial planning aspect in this as well, and Errol will tell you about it starts with a plan. But Desmond finds himself in the situation, and he's now asking about how do I ensure continued growth from an investment perspective. The answer is to make sure that you have a good spread of assets and in terms of asset classes that you've diversified, and importantly that you have the right level of exposure to asset classes such as equities and properties. Now, of course, in reference to his question that the market has not grown well, those are precisely the asset classes that have probably not given him the growth, but over a very short investment horizon, over a very short period of time. And the point we were making in today's presentation is that you need to have time on your side. So when you build that plan, you need to plan for that long time period, and of course adjust your expectations, your living standards in line with that so that your income drawdown allows you to meet that. I don't know, Errol, if you want to.
Yeah. I think people tend to confuse. I think that, with a good investment, the return is going to solve my problems, and that is absolute nonsense. I mean, it starts with financial planning.
Yeah.
Now, if you can't afford it, you can't afford it. Simple as that. You can't expect to have a high drawdown and then investment growth to make up for it. You've got to go back, tighten the belt, and go and sit with the budget and say, will this last me? Look at priorities. It starts with proper financial planning. And this is a trend worldwide. I think clients out there tend to think that my advisor is an investment specialist. It is not necessary. He is a financial planner. He's not a lawyer. He's not an accountant. And this is what the CFP designation, that's why people learn that. So you start with a solid financial plan. Can I afford it or can't I afford it? Now you use the investment, which is the solution, which is a product, which is the pill that the doctor would prescribe, and say, how can that solve my circumstances? Good, old, solid financial planning is the starting point.
Okay. All right, we'll look at about 2 more questions. Ellen Dando says, if a person is in their early 70s and has had very poor returns on equities in SA for the past 3 years, do they actually have enough time to wait for growth, or should they move heavily into cash and bonds? Someone said the equity cycle is about 19 years. Any comments?
Can I start with that one, Kitty?
Yes,
so Alan, I mean, what we don't know is the state of your health. We know your age at age 73, so there is limited information here. But really, to go down to the essence of your question is, at an advanced age, I've experienced poor returns. Do I change my strategy, and do I, as you've stated there, move heavily into cash and bonds? And it's similar to our very first question, which was after a very short time period, do I move into a money market investment? I think, as Errol put it to us, longevity is there. We are living longer. But as I've qualified that statement, is we don't know the state of your age. You've spoken about a 19-year equity investment cycle. Well, within all cycles, you're going to have many peaks and troughs within those cycles. And those in themselves may be aligned to your time period that you want to invest for. So, Alan, my advice or my view on something like that, because I can't give advice, is that one's got to almost go back and understand what my full investment time period is and invest accordingly. And if that investment time period is another 10, 20, 30 years from your current age, then it would, in my view, certainly not be the right decision to move out of equities and move everything into bonds and cash. You can certainly diversify by having some exposure to those asset classes, but you still need to have sufficient exposure to growth asset classes because of that time period that's involved.
I think, Wynford, one has to be very careful of stock picking according to the flavor of the market.
Yeah.
I mean, I still get it wrong every single time. I think the answer lies with your soccer field theory. It is how the asset classes are working together. For instance, and as I always say, I'm not an investment specialist, but just the fact that interest rates would increase, that surely would have a different impact on the different asset classes.
Sure.
So you need the best of both worlds. So effectively, it's about the maximum return with the minimum risk. And if you want to beat inflation, then you've got to take a little bit of more risk. But as you said, you need term. Those are the fundamental issues that one will have to look for. But it's not a question, should I move into equity or move only into bonds? It is the combination and the working together of the soccer team that's going to give you the desired outcome. And that is the discussion, I think, that should have taken place or perhaps should now take place.
Yeah, I would agree with that too.
Kenneth Gaino says, if I'm 60 now and retiring at 65, and you have a bond on your primary house, so he has a bond on his primary house, is it not better to withdraw funds from your retirement fund and to settle your bond now?
Kenneth, when I was a lecturer and I set a question for the master's paper, they all got it wrong. So this is a brilliant question, and this is not a popular one. You must decide from what perspective. I assume you're looking at from purely a growth on an after-tax point of view. So if that is so, because that is not the only criteria, there could be many other reasons why one will perhaps leave it in a pension fund, because it's protected against creditors. We've got a 37C of the Pension Funds Act and etc., where a bond cannot, and then a property is not protected. But let's assume it's purely from an investment point of view. The interesting factors are not the popular one, that it's often better to pay off your debt. Now the question is, if I have to pay tax to withdraw those funds, because you're going to be taxed at a higher rate, even after that tax, could it be better to pay that tax and actually withdraw more to cater for that tax? So you've got to withdraw more in that retirement fund and then pay the bond. Some calculations were done that it's actually better to pay off the debt. But that is only from a pure investment perspective, because when you pay off debt, it is a guaranteed return and tax is taken out. Now, where are you going to get a return before tax equal to paying off a bond? Now, if I can remember correctly, if your rate is 8% and at a 45% tax rate, Wynford, it should be something about 12, 13% guaranteed return. You're unlikely going to get that. But there's a lot more than at stake than that. So one has to look at it holistically and not only from an investment perspective. Sometimes you would have different goals. But interestingly, I'll end up with this. The whole reason with going on a retirement and allowing people to commute 1/3 of their pension fund, because the full amount should have gone into the pension, but you're allowed to commute 1/3. And the thinking was years ago that that 1/3 that you would take and to pay off all your debt so that you're debt free, because it would be ridiculous to retire from a fund and have a pension income and then pay into debt. So that's where the 1/3 actually comes in. So I think what you should do is to, as quickly as possible prior to retirement, make sure that that debt is repaid, but not necessarily to take the funds from the retirement annuity, because as I say, there are many, many other considerations that one has to take into account. Because a retirement fund, to a large extent, there are no taxes on it, there's no estate duty, the growth, the compounded, it's actually so much more, and it's actually nothing else than, I often refer to it as the poor man's trust. It's very similar to a trust fund. Those benefits are protected for the family. So you've got to take all these considerations into account. But that was an excellent question. Thank you for that.
Well done. And the last one, which will make it short because time is not on our side, is from JM. I'm missing the name now. James Davids. He says, I'm now in retirement for 8 months. The advice you have given, I've received. I'm a financial planner. I had to do a budget. How much do I need to live without touching the money that was invested for 5 years? How do I motivate others to consult a financial consultant and assist them? So this person is trying to promote financial awareness, financial knowledge. Errol, that's yours, the last one.
Go out there and educate people. I find there's a lack of education. And people must be allowed to make informed decisions. So a financial planner's job is actually to educate people like we've been doing now with the investments. So go out and do that. I've been involved with universities, with our youngsters, and what I've seen 10 years later, the fruits of those labor, there are some brilliant ones actually coming through at the moment.
Well done. So promote the word. Thank you very much. Ellen Dendo, thank you very much. We see your kind words. We glad the experience was a positive one. We hope everybody benefited from this experience and you can share the word. Till next webinar, we'll see you then. For those who asked, the session is recorded. You will get a thank you note in about a day or two. It will give you a link where you can go to the Standard Bank YouTube site where you can get the recordings of all the webinars that we do broadcast to you folks. If you're a staff member, you know where to get it. It's on our SharePoint portal internally. We'll see you next month. There'll be another webinar. You'll get an invite closer to the time. On the thank you note as well, if you are looking for a financial planner, there's a number that you can SMS. Someone will contact you and the financial planner will be in touch. Or else move into any Standard Bank that is closest to your Standard Bank branch. Ask for a financial planner. There's always one in the branch and someone will definitely be able to assist you. Thank you very much for taking the time to sit in and join us for this webinar. We hope you enjoyed it and we'll see you next time. Goodbye.